In every financial cycle, there comes a moment when investors begin searching for signals that confirm their fears rather than challenge their assumptions. The idea that three publicly available indicators can reliably predict systemic collapse is appealing not because it is necessarily accurate, but because it offers clarity in a complex world. However, clarity and correctness are not always the same thing. The argument that financial crises follow mechanical sequences sounds persuasive. It suggests that markets behave like engineered systems with pressure gauges that warn investors before failure occurs. But financial markets are not boilers. They are adaptive networks shaped by policy responses, liquidity interventions, institutional positioning, and global capital flows that evolve over time. Treating them as mechanical systems risks misunderstanding the very flexibility that allows them to survive stress. Consider the claim that crises are predictable because structural pressure builds gradually before a trigger event. This framing assumes that structural pressure today resembles structural pressure in 1987, 2000, or 2008. Yet the architecture of the financial system in 2026 is fundamentally different from each of those periods. Banks hold more capital than they did prior to the global financial crisis. Central banks operate with expanded policy tools. Liquidity backstops exist today that simply did not exist decades ago. The system has changed, which means the signals must be interpreted differently as well. The belief that markets collapse once a certain threshold is crossed also overlooks a critical reality. Markets constantly cross thresholds without collapsing. Rising volatility, widening spreads, and sector-specific stress occur frequently within normal economic transitions. These are not signs of imminent systemic failure. They are signs of repricing. One of the central assumptions behind the three-indicator framework is that financial crises are primarily structural rather than policy-driven. Yet modern crises are increasingly shaped by policy response speed rather than structural weakness alone. In 2020, markets experienced one of the fastest collapses in modern history and one of the fastest recoveries. What changed the outcome was not structure, it was intervention. This distinction matters because it alters how investors should interpret stress signals today. When policymakers respond quickly and decisively, the probability that structural stress evolves into systemic collapse declines dramatically. The presence of warning signals no longer guarantees escalation. Another weakness in the three-indicator argument is its reliance on historical pattern repetition. Pattern recognition is useful, but only when the underlying variables remain stable. In reality, the role of fiscal policy, global liquidity distribution, sovereign debt demand, and institutional positioning has shifted significantly over the last 15 years. For example, passive investment flows now dominate equity allocation in a way that did not exist during earlier crises. Sovereign wealth funds play a larger stabilizing role. Pension systems operate under different regulatory incentives, and central banks are far more willing to intervene preemptively when stress begins to appear. These changes do not eliminate risk, but they do change how risk propagates through the system. Perhaps most importantly, the narrative that investors must react once 2 out of 3 signals begin flashing assumes that markets move linearly from warning to collapse. In practice, markets spend extended periods pricing uncertainty without transitioning into crisis. Signals can flash for months or even years before anything breaks. Being early is often described as harmless underperformance. In reality, being consistently early can be extremely expensive. Missing extended equity rallies while waiting for structural confirmation of crisis is not simply an inconvenience. It can permanently reduce long-term portfolio compounding. This is the paradox of macro warning systems. They are powerful tools for identifying risk, but they are weak tools for timing markets. And timing is everything. Before investors accept the idea that today's environment resembles the early stages of previous collapses, they need to examine the first signal more carefully: the 10-year Treasury yield. Because rising yields are not always a warning sign of instability, sometimes they are evidence of economic resilience. And misunderstanding that distinction is where many crisis narratives begin to fall apart. The idea that a 5% yield on the 10-year U.S. Treasury automatically signals systemic danger sounds convincing at first glance. After all, the 10-year yield sits at the center of global asset pricing. It influences mortgage rates, equity valuations, commercial real estate financing, and corporate borrowing costs. When it rises sharply, financial conditions tighten. That much is true. But tightening financial conditions is not the same thing as systemic instability. In fact, the assumption that yields above 5% represent a danger zone depends heavily on a historical comparison that no longer applies to the current macroeconomic environment. For most of the decade following the global financial crisis, interest rates were artificially suppressed by extraordinary central bank policy. Quantitative easing pushed sovereign yields to historically abnormal levels. Investors became accustomed to a world in which borrowing costs near zero felt normal. But that environment was not normal. It was emergency policy extended over many years. When viewed through a longer historical lens, a 5% 10-year Treasury yield is not extreme at all. It is close to the long-term average level of government borrowing costs across multiple economic cycles. During the 1990s expansion, one of the strongest economic decades in modern American history, the 10-year yield frequently traded well above today's levels. Yet markets did not collapse. Growth accelerated. This matters because interpreting yields correctly requires understanding why they are rising. There are two fundamentally different types of rising yield environments. The first is stress-driven. In that scenario, investors demand higher compensation for holding government debt because they fear instability, inflation spirals, or fiscal deterioration. The second type is growth-driven. In that scenario, yields rise because economic activity remains strong, labor markets remain tight, and inflation expectations remain anchored above the ultra-low levels of the previous decade. Those two environments look identical on a chart, but they mean completely different things for investors. Today's yield environment contains elements of both, but the dominant driver is normalization rather than panic. Real yields, not nominal yields, tell the more important story here. When real yields rise, it typically signals that investors expect sustained economic activity rather than imminent collapse. Higher real yields reflect confidence that capital still has productive opportunities in the private sector. That is not what systemic breakdown looks like. Another overlooked factor is global demand for U.S. Treasuries. Even with yields approaching levels not seen in years, international capital continues to treat Treasury securities as the world's primary safe asset. Foreign reserve managers, pension systems, insurance companies, and sovereign wealth funds still rely on treasuries as the backbone of portfolio stability. That demand creates a structural floor under the bond market that did not exist in earlier crisis periods in the same way. Equally important is the relationship between yields and equity markets. If rising yields truly signaled immediate systemic stress, equity markets would already be reacting violently. Instead, markets have shown resilience during multiple periods when the 10-year yield approached or briefly exceeded the 5% threshold. That resilience suggests investors are interpreting higher rates as a repricing of capital rather than a collapse of confidence. There is also a fiscal dimension that complicates the argument further. Higher Treasury yields increase government borrowing costs, but they also reflect the depth and liquidity of the world's largest sovereign debt market. The United States continues to issue debt at a scale unmatched globally, and yet demand remains persistent. Markets are not rejecting Treasury issuance. They are absorbing it. That distinction matters. A true crisis signal in sovereign bond markets does not appear when yields rise gradually toward historical averages. It appears when auctions fail, liquidity disappears, and volatility becomes disorderly. None of those conditions define the current environment. Perhaps the most important misunderstanding in the 5% danger zone narrative is the assumption that asset valuations cannot adjust to higher discount rates. They can. Markets adjust constantly. Equities reprice. Credit spreads shift. Real estate valuations recalibrate. Capital rotates towards sectors that benefit from higher nominal growth environments. None of this requires systemic collapse. It requires adaptation. And adaptation, not fragility, is the defining characteristic of modern financial markets. Which brings us to the second signal often cited as evidence that structural weakness is already spreading beneath the surface: the behavior of regional banks. Because if the regional banking sector truly represented a reliable early warning system of crisis, it would already be sending a much clearer message than the one investors are currently seeing. The idea that regional banks function as a reliable early warning system for systemic crisis is one of the most widely repeated assumptions in modern macro commentary. It sounds logical. Regional banks are smaller, less diversified, and more exposed to interest rate sensitivity than global institutions. If stress appears there first, the argument goes, it must eventually spread everywhere else. But that conclusion confuses sector-specific weakness with system-wide fragility. Regional banks today are not collapsing because the financial system is breaking. They are adjusting because the structure of banking itself is changing. To understand this distinction, investors need to step back and examine what actually drives regional bank performance. Unlike the largest money center institutions, regional banks rely heavily on two core business models: commercial real estate lending and deposit-based funding spreads. Both of those models were designed for a low-rate environment that persisted for more than a decade after the global financial crisis. When interest rates rise rapidly, those models naturally face pressure. That pressure does not automatically translate into systemic instability. It reflects margin compression, balance sheet repricing, and regulatory transition. In other words, it reflects adaptation, not collapse. The comparison many analysts make between today's regional banking stress and previous banking crises also overlooks one of the most important changes in modern financial regulation. After 2008, capital requirements increased dramatically across the banking sector. Liquidity coverage ratios improved. Stress testing frameworks became routine rather than exceptional. Regional banks today operate inside a regulatory structure specifically designed to prevent localized stress from becoming systemic contagion. That structure matters more than short-term stock price movement. Consider the role of market pricing itself. When the regional banking ETF declines significantly from its highs, it does not necessarily mean investors are anticipating insolvency. It often means they are anticipating slower earnings growth. Equity markets price profitability expectations long before they price solvency risk. Those are very different signals. Commercial real estate exposure is frequently cited as the primary reason regional banks are vulnerable. Office vacancy rates have indeed risen sharply in major cities, and refinancing conditions are tighter than they were 5 years ago. But commercial real estate cycles unfold slowly. Loans mature over multi-year timelines. Loss recognition occurs gradually rather than suddenly. That timeline gives regulators, lenders, and borrowers room to restructure obligations before they become destabilizing events. The collapse of Silicon Valley Bank is often presented as evidence that regional institutions remain fragile. In reality, it demonstrated something else entirely. It demonstrated how quickly policymakers are willing to intervene when instability threatens depositor confidence. Within days of the failure, emergency liquidity facilities were expanded, deposit guarantees were clarified, and systemic contagion was contained. Markets received a clear message. Authorities are prepared to act before stress spreads. That message changes how regional bank signals should be interpreted today. Another overlooked factor is the migration of deposits toward higher-yielding alternatives. Money market funds now offer competitive returns relative to traditional bank deposits, encouraging capital movement across the financial system. This shift pressures regional bank funding costs, but it does not represent credit system failure. It represents competition. Financial systems evolve when competition changes. Investors also tend to underestimate the diversification of credit risk across the modern financial landscape. Credit creation is no longer concentrated exclusively inside the banking sector. Private credit funds, institutional lenders, and capital markets now play a much larger role in financing businesses than they did during previous cycles. That shift reduces the probability that weakness inside one banking segment automatically translates into economy-wide credit contraction. Even the widely cited threshold of a 30% decline in regional bank equities deserves closer scrutiny. Equity prices reflect expectations, not balance sheet reality. Markets routinely overshoot during repricing cycles. A decline of that magnitude may indicate uncertainty, but uncertainty alone does not create crisis. True systemic warnings appear when liquidity disappears entirely, when interbank lending freezes, and when deposit flight spreads uncontrollably across institutions. Those conditions are not defining today's environment. Regional banks are not acting as a canary signaling collapse. They are acting as a mirror reflecting how the financial system is adjusting to higher interest rates, tighter capital discipline, and a more competitive funding environment. Which brings us to the final signal often presented as the decisive confirmation of crisis risk: the widening spread between high-yield and investment-grade credit. Because if there is one indicator that truly reveals whether financial plumbing is beginning to freeze, it is the behavior of credit spreads. And what they are actually telling investors right now is far more nuanced than the headline numbers suggest. Among the three indicators often presented as warning signals of financial crisis, credit spreads are typically described as the most decisive. The argument is straightforward. When the gap between high-yield bonds and investment-grade bonds widens beyond a certain threshold, liquidity begins to disappear from the weakest parts of the economy. And once liquidity disappears, collapse becomes unavoidable. Historically, that argument has merit, but applying the same threshold logic to today's market environment ignores how dramatically the structure of corporate credit has changed over the past 2 decades. Credit spreads do not widen simply because investors are afraid. They widen because investors are becoming selective. Selectivity is not the same thing as panic. In previous crisis cycles, widening spreads reflected the sudden withdrawal of capital from entire segments of the economy. Banks stopped lending. Bond markets stopped functioning. Companies lost access to refinancing. Liquidity vanished simultaneously across sectors. That is what a credit freeze looks like. Today's environment looks different. Corporate balance sheets entered this tightening cycle stronger than they were in most previous periods of monetary transition. Many large firms locked in low borrowing costs during the decade of ultra-low interest rates. Debt maturities were extended. Liquidity reserves increased. Refinancing pressure was delayed. As a result, the transmission mechanism between rising rates and corporate distress has slowed significantly. This matters because timing, not direction, is what determines whether spreads represent a warning signal or simply a repricing process. Even when spreads begin moving higher, they often reflect investor discrimination between strong and weak borrowers, rather than broad systemic withdrawal of capital. High-quality firms continue to access funding. Investment-grade markets remain open. New issuance continues. That is not what happens before crisis. Another important shift has taken place outside traditional bond markets. Private credit has expanded rapidly over the past decade, creating an alternative channel through which companies can obtain financing when public markets become less accommodating. This parallel credit system acts as a stabilizer during periods when spreads widen in public markets. Instead of disappearing, liquidity migrates. That migration changes how investors should interpret widening spreads today. It also explains why the commonly cited 6% threshold cannot be treated as a universal trigger across cycles. Thresholds derived from past crises assume a credit system dominated by banks and public bond markets. Today's credit ecosystem is broader, deeper, and more flexible. Signals still matter, but they must be interpreted within the structure of the current system, not the structure of the past. Perhaps the most important misunderstanding behind the three signals framework is the assumption that indicators alone determine outcomes. Indicators reveal pressure. They do not determine policy response. And policy response now moves faster than at any point in modern financial history. Central banks monitor credit conditions continuously. Liquidity facilities can be deployed quickly. Swap lines between major economies remain active. Regulatory coordination across financial institutions is stronger than it was in earlier decades. These tools do not eliminate risk, but they dramatically reduce the probability that stress evolves into uncontrolled collapse without warning. That distinction changes how investors should think about the current moment. The presence of two warning signals does not mean a third must follow, and even if the third appears, it does not guarantee systemic failure. It means volatility is increasing. It means capital allocation decisions are becoming more important. It means investors must become more selective. But selectivity is not crisis. In fact, the most consistent lesson across modern market cycles is not that investors should react to warning signals by exiting risk entirely. It is that they should rebalance exposure intelligently as conditions evolve. Markets are not approaching a hidden cliff edge. They are moving through a transition from a zero-rate world to a positive-rate world. And transitions feel dangerous precisely because they force investors to adjust assumptions that had once felt permanent. The real signal investors should be watching right now is not whether three indicators are flashing simultaneously. It is whether capital continues to move. Because as long as capital keeps moving, markets keep functioning. And when markets keep functioning, crisis remains a possibility, not a certainty.